start recording and I will start the broadcast.
Welcome everyone. If you've just joined, we're just waiting to the hour before we start. Just be patient. We'll aim to kick off on the hour. Thank you. Welcome everyone. If you've just joined, we're just waiting for the hour to kick things off. Just please bear with us. We'll endeavour to start in due time. Thank you. Hi everyone, if you've just joined, we're just waiting on some people to join from the waiting room. We'll be looking at kicking off on the hour as planned. So thanks for your patience. Hi everyone. If you've just joined, we're just waiting a few moments for people to enter from the waiting room, and then we'll look to kick off just a couple of minutes past the hour. Please bear with us. Hi everyone. If you've just joined, we're just giving it a few moments for some people to enter from the waiting room, and we will look to kick things off very shortly. Thank you. Okay, look, welcome everyone, and thank you for joining. My name is Adam Evident, and I lead our Savills cross-border tenant advisory platform in the Asia Pacific region. Look, it's my absolute pleasure today to be moderating this panel discussion and presentation, APAC Industrial and Logistics, Emerging Trends, Focus on India and Southeast Asia. For these discussions, we've pulled together a team of local in-market experts and business leaders from across the region to share their experience, their insight, their perspectives. I'll let my colleagues introduce themselves as we go through the country presentation, but look, suffice to say that I could not ask for a better team in support to join this discussion. They're a group of people that are grounded in their markets and are really at the coalface of some of this dynamic change and activity that we're seeing in region. So look at the format agenda for today's discussion is really straightforward. So I'd like to start at the outset introducing some what we call some major trends or macro themes, I suppose, that are really driving some of this activity and change around industrial and logistics. And then hand over to my colleagues to provide an overview of their markets and what they're seeing. Of course, at the end, we'd like to leave some time at the end to address any questions that are raised along the way. And please, I'd encourage people, you'll note that on entering the presentation, you've been muted. Please post any questions you have to the Q&A panel at the bottom of your screen. And as I say, we'll look to address that at the end. But I suppose without further ado, we should look to get started. So, look, I think just to commence, make the point that the economies of India and Southeast Asia have really been dynamic engines of growth for some time. I think the stories of the tiger economies and emerging markets in this part of the world has really been well documented. I think looking below that, the industrial and logistics sectors, the story is certainly no less interesting. And as I say, where I'd like to start the discussion is really exploring some of these major themes, these four macro trends that are kind of weaved into the conversation that's going to follow here today. And the first one there to mention is the US-China trade tensions. So look, the recent ongoing tensions has really had an undeniable impact on the way industrial manufacturers and logistics companies have looked at, have strategized for, and planned for geographic risk and supply chain security. This is certainly a theme that is going to reoccur as we go through the country presentations. The second one there, no presentation these days will be complete without it, but mentioning COVID-19. And I mention it for two reasons. The first point to make here is that the industrial and logistics activity in the real estate sector has really been a standout performer against other classes of real estate over this recent period. As you know, economies have undoubtedly struggled and grappled with the challenges that COVID-19 has thrown up. That's the first point. And the second is really that COVID-19, one could argue, is really perhaps accelerated and highlighted some of these existing trends, perceivable trends in these markets. So again, something to keep in mind when we're hearing from our colleagues. The third point there is around labour costs and accessibility. If we just go to the next slide, I think this graph on the left-hand side there really speaks to that, around the structural changes in economies and wage profiles of major economies, and most notably there China over the last 2 decades certainly, that have been driving a rethink of manufacturing locations and approaches. If you look at that spread of wage points across the region, it really does tell its own stories, and that, as I say, will be explored further here today. The last macro trend that I want to touch on is this one of emerging markets and really the domestic opportunities seen in their own rights in India and Southeast Asia. India and Southeast Asia are reaping what we like to call the demographic dividend of large and comparatively youthful populations. Really delivering workforces and domestic markets that are expected to drive growth and opportunity in these markets for many years to come. And something to keep in mind when we look at these issues of e-commerce and these new business models emerging, not just looking at these locations as a piece in the puzzle of a global supply chain or part of a global industrial network, but really as markets in their own right, and that is certainly something that's driving a lot of interest, activity, and investment in these markets. So as I say, with that, perhaps setting some context and providing some background, I'd like now to hand over to my colleague Michael McCulloch from our Philippines business to provide a brief introduction of himself, and then to step us through the Philippines market. Over to you, Michael. Thanks.
Thanks, Adam. Good to see us in the same office together here, virtually. All right. My name is Michael McCulloch. I've been a founder of the business about 11 years now, and I'll walk us through some of the manufacturing and logistics news for the Philippines. For those who are not attending live, you can pretty much read through all of this, but the Philippines had I think the worst drop in GDP for the last 30 years, and particularly I think within Southeast Asia of a minus 16.5%. The lockdown was particularly tough and long, and it has created a serious damage in the underlying economy, put about 10 million people in unemployment, but we are on the road to recovery. Some of the pillars of the economy are foreign tourist arrivals, which has generally been up year over year. OFW remittances, that is our foreign overseas workers, which typically live in places like Hong Kong, United States, Middle East, Europe. Many of them are nurses. We are known for our Philippine hospitality, And those who don't leave us work in the call center and BPO and contact center industry, which brings about 25 billion of revenue every year into the country. I think that's about it. Next. So just want to talk about the massive dip we saw in the manufacturing sector. Luckily, it's starting to stabilize this September. Something like 85% of all manufacturers are back online. Overall, the Visayas or the Cebu region got hit particularly hard due to their extended and even more strict lockdown. So 25% of their manufacturing capacity has not come back online yet, but it should do so over the next few months. Overall, Luzon, which is kind of the powerhouse of GDP, it has come back, and Mindanao, which is another island, didn't have as much downtime. They're less affected by the lockdown. Next. So the Metro Manila lease rates, I've done this in US dollars per square meter per month. Right there, you can kind of see the city of Manila, that is old historic Manila. Metro Manila would be pretty much all of those next neighboring locations on the map there. And you'll see lease rates from kind of a low in Metro Manila of US $2.90 per square meter per month, all the way up to about 15 US dollars per square meter per month. The North Luzon region, which would be in the north of the map, is a much more affordable range in the $3.50 to $4 per square meter per month. And South Luzon, which would be in the southern part of the map, which has a lot of supply and many of the industrial parks and light manufacturing hubs would be down in the south. Obviously, e-commerce has been a really strong story, I think, for pretty much all of the developing nations within Southeast Asia. We are known to be a malling country where the weekends are spent at the malls, and that has changed forever with foot traffic dropping by up to 90%. Some of these malls are actually being turned into warehousing spaces unsuccessfully for now, but we do expect that to be a trend. The third-party logistics players have taken up massive amounts of warehouses, any available warehouse. Those such as DHL, DB Schenker, they're always on the lookout for, they're very price sensitive for affordable warehousing. Okay, next. There we go. Industrial land and construction cost. While we say there is ample industrial land, I mean, there is ample land. Some of it needs to get converted into what we call PEZA, or Philippine Economic Zone Authority, to become very attractive, particularly for the export sector. And construction costs have actually held steady within the Philippines, although our construction cost is probably higher than some of the other countries, particularly maybe twice the price as Vietnam or China, but still somewhat affordable. We don't make a lot of those materials, so all of that is imported. If you are with PEZA, you can import that with tax incentives or tax-free, with no VAT, no customs or duties. The warehouse requirements by industry. We have a very unique handicraft, which is in the wood making and wood carving for furniture. We're also known for our rattan furniture, which we export globally. The next one, I believe, is for industrial machines, followed by the maritime industry and third-party logistics. Retail is a growing segment, though, particularly because they have to store things. I think that's about it. Next. So where the Philippines is at in terms of their e-commerce story, We are just at the beginning of it. Like I said, we are a malling culture. We love to go to the malls on the weekends, and we have some of the largest malls in the world. And we were not big fans of e-commerce. The credit card penetration rate in the Philippines is roughly kind of 3% or so. All that is moving upwards. So online sales have had to figure out with delivery, cash on delivery, and some of these other issues for scaling, which other more advanced economies like maybe say Malaysia, Singapore have not had to deal with. Currently, we're at 1% of total retail sales is through e-commerce, but we, again, this is all prior to COVID. We believe that has skyrocketed. It is almost the only way to shop or buy food, particularly takeout food or food delivery. Again, prior to the pandemic, online sales were expected to reach $3.37 billion. Surely that is going to jump, I don't know, potentially as high as they say 40 to 50%. And the annual growth rate for e-commerce sales is approximately 20%. And that's probably a very conservative assumption. I think the pandemic has been a paradigm shift in how consumers spend their money within the Philippines. Next. So the current tax regime, PEZA stands for Philippine Economic Zone Authority, which makes it a compelling reason to invest here, particularly to set up export manufacturing facilities. You get 100% exemption from corporate income tax for at least your first 4 years. After that expires, it can be extended. After that expires, it's about a 5% special tax on your gross income, and you are exempted from national and local taxes. Tax and duty-free importation of raw materials, capital equipment, machineries, and spare parts. Exemption from wharfage duties and export tax, impost, and fees. VAT zero rating, so anything you buy would not have the 12% VAT. And like I said, you're exempted from the local payment of taxes, fees, and licenses. And you don't have to deal with local government. So you're not being shaken down per se by some of these cities as you might be in maybe other locations or other countries. Next. So my last 3 points here. Why the Philippines? Availability of a highly skilled English-speaking workforce. We're the third largest English-speaking country in the world. Competitive shipping costs out of the Port of Manila, which is one of the largest ports in Asia and Southeast Asia, including air freight. And you can export using the Philippine flag with friendlier trade agreements, particularly to the US, because the Philippines has had a long history of trade and partnership. These are some of the notable companies that are currently manufacturing high-end kind of electronics and assembly work. And then a quote from the United States Department of State. Noteworthy advantages of the Philippine investment landscape include free trade zones, including economic zones, and a large educated English-speaking and relatively low-cost Filipino workforce that aims to please. And I believe I have finished my presentation for the Philippines. Thank you very much.
Thanks, Michael. Over to Jaranat from Thailand. Thanks, Jaranat.
Hi guys, my name is Jarunat from Savills, Thailand. So thank you everybody for joining the meeting today. So to get started, let me give you a brief details about Thailand. Thailand, we have a total population of 69 million at the moment, and we are the second largest economy in Southeast Asia. We are top 10 most tourists visit in the world, and number 2 in Asia, just below China. And yeah, so that's a little brief detail about Thailand. Next slide. So let's start with BOI. As you all know, Thailand has been one of the most place for people to come open their manufacturing plant in terms of Automotive, we are like a top 6 in the world, top 10 in the world, #1 in Asia. And right now, the government in Thailand, they have investment incentives. They want to attract more people to come invest in Thailand. And right now, we are looking at the, as you can see from the group, it's from A1, A2, A3, A4. So you start with the 8 years, 3 to 8 years with no corporate income tax. These are grouped by the manufacturing type. The more research and development you give, the higher exemption you will get. So as you can see from the group A1, so if you focus on research and development, you'll get 8 years with no corporate income tax, exemption of import duties, exemption of raw material, non-tax, even you can get like a freehold land from yourself. And in A2, so if you activities in the infrastructure for the country development using advanced technology, so you will get 8 years as the same, but the things you won't get is the exemption of the import duty. And as you can see on the screen, A3, A4, and B1, B2. So the higher the research development, the more incentive you would get. So this is how we use to give the promotion incentive. So with the next slide. Okay, and then just last year, the government of Thailand, they have just announced the new EEZ target industry. So EEZ stands for Eastern Economic Corridor. So it has a total area of 13,000 square kilometers. So with this, the government are trying to promote and give to promote the area, which is the 3 provinces, which I'll show you later in another screen. And as you can see, the phase one is the existing industries that is already in Thailand, which is the automotive industry. They are trying to move it into next generation. We have a Great Wall from China that are coming to open their factory in Thailand. They're doing with the next generation. And the electronic industries, they are trying to move it into the more intelligent agricultural, biotechnologies, food processing industries. As you know, Thailand is top in the food chain in the world. And then the medical and tourism industries. Tourism, of course, we are one of the best. And for the healthcare and medication, we are 6th in the world out of 89 countries that are surveyed by the CEO World in 2019. So with this phase one, the government are trying to make it more into research and development, and then more into high technology. And after that, in the phase two, this is the new industries that the government trying to promote. If you're coming into the phase two, like digital industries, robotic industries, aviation, comprehensive healthcare industry, biofuel, biochemical, these are the industries that we are quite limited and we want to expand in Thailand. With the benefits, apart from what you get from the BOI, the tax, the corporate income tax, from 10, you can get maximum up to 13 years. The import duties, you don't have to pay any import duties or VAT for your production and R&D. And then you get the investment matching grant. You get permission to own land, which you don't have to pay rent. You can just buy 100% freehold for foreigners. And you have the lowest personal income tax in ASEAN, which is 17% for qualified. And you have one-stop service center for the visa and work permit. It will take you a total of 3 hours just from visa and get work permit done if you stay in the EEZ economic zone. So this is quite the thing that the government trying to promote. And I'll show you in the next slide about the infrastructure. So the next slide, please. Okay, this is the key infrastructure project in the EEZ. As for now, the government has already announced that they're going to invest $43 billion in the first 5 years, calculated using from the last year. So they already started expanding the Lam Shabang port. Lam Shabang port is the largest port in Thailand, followed by Satilip port and Mataput port. So we are expanding into phase 3. And Utapao Airport, this is going to be the second largest airport in Thailand, apart from the Suvarnabhumi airport that we have. So there will be a lot of international flights, a lot of logistics flights are flying into Utapao Airport. And it will be located, as you can see on the third in the middle, between Chonburi and Rayong, which is the most popular area for the industry. All the big names like General Motors, BMW, Mercedes are located in these two areas. And as you can see in the right corner, the EEC, you can see they're investing in the Utapao Airport, $5.7 billion, Mataput Port, Lamchabang Port. We are going to have the high-speed train coming up in the next 5 years. So from Bangkok to Mataput Port, which is the farthest, it will take you maximum up to 1.5 hours only. And it's located almost 300 kilometers away. And we're going to have the dual track railway all across Thailand. This will help in terms of logistics, the motorway, and then the industrial tourism. And we're going to have a new city and hospital special for this EEC. So this is the key infrastructure project that the government are investing, and they have been already started. And then the next slide, please. So this is the Central Thailand Industrial Estate. As you can see on the map, number one, the Bangkok is in the middle. So when we talk about industrial in Thailand, so we use central, north, east, and west. So the pink one is the north and west. As you can see, this one is Pathum Thani, Ayutthaya, Saraburi, and Ratchanaburi. These three provinces are famous for the food industry because there's a lot of water usage, a lot of water that can supply. And the second one, Chao Chen Sao, Chonburi, Rayong, in the yellow. This one is the EEC that the government is trying to promote. And the one is Bangkok and surrounding the Samut Prakan, Samut Sakhon, and Samut Songkhram. So these are famous for textile and logistics because it's in the middle. It can go left, right, up, and north, south. So it's all the, I would say, as you can see on the right, 95 to 98% of Samut Prakan area is the occupancy rate. And all the market-wide, we have 85% occupancy rate. So there's only 15% that is available on the market, which is, we are quite happy about that. And we are keep on expanding and expanding. And for the rent, the ready-built warehouse and factory average rental rate, as you can see, it's $3 to $8 per square meters per month. This is from grade C up to grade A. And the freehold land, when you buy, if you want to buy the land in the industrial estate, it starts from $80 to $240 per square meter. This is the freehold land. And the price of the land, you can say it's come up about 1 to 2% almost every other year. So the next slide, please. So this is the labor cost in Thailand. In conclusion, as you can see, the unskilled, semi-skilled manufacturing labor, we are not the cheapest in the Southeast Asia, but we have a lot of unskilled that is being there and they know what they want to do. And as you can see, the average of the labor cost, it's about $14 to $15 per day. This includes all the wages, allowance, social securities, but does not include the overtime, of course. And the labor cost, the skilled workers, the one in the office, the technician, engineer, accountant. So it starts from $300 and it goes to $3,800 for the senior manager level with the bachelor's degree. Yes, so this is it from the Thailand office. Thank you, everybody.
Excellent. Thanks, Jarnat. John, over to you for Vietnam.
Yeah, thanks, Adam. Thanks, everyone, for tuning in this evening and tonight. So to begin, I would say the last 20 years has seen Vietnam transition from an agricultural-based economy to one of the most popular manufacturing and industrial hubs in Asia. So once a location associated with low costs and high volume manufacturing, the country is now transitioning from low skilled and labor intensive industries towards higher value industry. And with the recent US-China trade war and the EU-Vietnam Free Trade Agreement, the opportunity for manufacturing and logistics is far greater than it was 10 to 15 years ago. First slide, please. Just a quick overview of the ASEAN region here. Some key takeaways include Vietnam's relatively large population, a large and young population, giving rise to a young and dynamic workforce. It's a healthy growing GDP. Obviously, this is before COVID-19 at the bottom, but Vietnam is forecasted now to be growing this year at around 2.3%, which is relatively good compared to a lot of the countries in Southeast Asia. Interestingly, at the top here, we have a total number of industrial parks, which is quite impressive at 327 established IPs. Impressive for a country of its size, and quite a lot more industrial parks than some of its counterparts in Southeast Asia. Below that, we have the average minimum wage. Again, this has always been a key driver, especially for the low value added manufacturers, such as the companies in textiles or furniture. Next slide, please. So what are the drivers? Why have multinational companies been coming to Vietnam the last 10, 20 years, and why are they continuing to show interest? So as I mentioned, labor costs has always been a key driver, particularly for the low value added manufacturing. Affordable land price and sea freight. Although land price has been rising quite a bit since 2018, it still remains competitive in Asia. Favorable corporate income tax rates. There are preferential tax incentives offered by the Vietnamese government for certain industries, such as manufacturers of high-tech or supporting high-tech products, or those in renewable energy or smart agriculture can also get these incentives. Apart from industry, we also have some special economic zones or difficult socio-economic zones whereby investors are also given the preferential tax rates. So the standard corporate income tax is 20%, and then the preferential can be as low as 15 to 17%. As I mentioned, the large and young population, 96 million people with a young and dynamic workforce. Very important for logistics. We have the country's geographical location near source and destination markets on the southeast of the Indo-Chinese peninsula. So this gives Vietnam access to the world's major seaborne trade routes. And as an alternative to China, a lot of companies favor Vietnam for its stable government, fast growth rate, and overall improving business climate. However, for 2019 and this year, I would say in terms of drivers, the biggest highlight would be Vietnam's participation in multiple free trade agreements. Last year, we had the signing of the CPTPP and the EVFTA in June last summer. This summer in 2020, we see the official ratification of the EU-Vietnam Free Trade Agreement, both ratified by the National Assembly in Vietnam and by the EU Parliament. So this, in the long term, is expected to help Vietnam a lot. It's the most ambitious trade agreement the country has ever entered into. It's set to eliminate custom duties by 99%, and it's also going to improve the type of industries that are looking at Vietnam. As I mentioned earlier, the higher value industries looking at Vietnam. So now we have different countries and different investment sectors looking at Vietnam, and Vietnam, on the other hand, is going to be expected to improve its overall education system, its training, so it can provide more skilled labor to accommodate these high value investments in the future. So I believe that's how the EVFTA is going to improve, especially the labor force in the long run in Vietnam. Next slide, please. With regards to industrial land supply, so as I mentioned, there's 327 established industrial parks in Vietnam on approximately 96,000 hectares. Of those, 256 parks are operational, with occupancy reaching 75%, up from 74% last year. So demand continues to outpace supply, which is a bit of an issue. So there is a clear need for more industrial supply, more industrial park projects in some of the key industrial provinces, like Bac Ninh and Hanoi in the north, and Dong Nai, Bin Nhung, and Ho Chi Minh in the south. So we have 71 industrial parks under construction, site clearance or compensation, but we certainly need more, especially from next year onwards, when the investors can travel to Vietnam again after the flight restrictions are lifted. On the right there, you just see a map of the three economic zones in Vietnam: north, central, south. The north and the south are the biggest economic zones in terms of manufacturing investment. The central economic zone is a bit more in its premature stage. So the north economic zone, generally known for getting the bigger manufacturing projects. For example, the big Samsung project is the biggest FDI investor in Vietnam. They have over $17 billion invested in Bac Ninh province, just outside Hanoi. We also have LG from Korea as well, with some big investments there in Hai Phong. The south, on the other hand, is generally known as being the industrial and economic capital of Vietnam. So Hanoi is the capital of Vietnam, but Ho Chi Minh is like the economic or commercial capital, I think is fair to say. So a lot of the industrial parks in the south, some of them are older than the north. A lot of the country's first parks were in the south. So as I said, you'll see the big projects in the north, but I think there's a more diversified sector investment in the south. So you can find any project, whether it's F&B, FMCG, e-commerce, logistics, textiles, electronic components, or automotive, you can find in the south. Next slide, please. With regards to the first half of this year, obviously we've seen a reduced amount of FDI investment in the manufacturing sector compared to last year. However, manufacturing has still accounted for a significant 51% of total FDI inflows in the first 6 months of this year, with over $8 billion. So that's out of a total of 15.6 billion, which is down minus 15% year on year. However, still quite competitive against other countries in Asia on the back of COVID-19. Manufacturing PMI, the Purchasing Managers Index, and Index of Industrial Production, both indexes have been hit pretty hard in the first 3 months. So if I was going over the Q1 figures, they might not be so good. But luckily, in end of Q2, after the first 6 months of the year, we see some big improvements in both manufacturing PMI and industrial production. PMI, for example, has soared to 51.1 points in June, up from 42.7 in May. So this actually marks the first growth since the very beginning of the year in January, before the pandemic outbreak. So this can be attributed to increase in new orders, purchasing activity, and pre-production inventories rising. Industrial production, on the other hand, up 7% year on year in June, from a very low performance in May of minus 3.1%. We've seen the upturn in manufacturing production with 10.3% versus minus 2.4% in May. So overall, by end of year, we should see industrial output up around 2.7% year on year. So yeah, it's been quite an interesting year so far in terms of both of those measurements, but let's see where we are by the end of this year. Next slide, please. Okay, so obviously one of the main topics of this year is the COVID-19 and implications. I'm not sure if some of you have been reading any of the news outlets around Vietnam, but it's been covered quite well around Asia that Vietnam's rapid response to the pandemic this year, and that can be attributed to Vietnamese government acting very promptly and strongly since the very first wave, which has definitely paid off for Vietnam. Also, Vietnam has a number of factors that have helped it in overcoming the initial adversity of the pandemic, such as its robust and growing middle class and dynamic private sector, as I mentioned, with the stable business environment, and of course the government's continued public spending to contain the pandemic and ramping up the infrastructure spending as well. When I mentioned about the EV FTA earlier on, I think it's important that was signed and ratified this year of all years, you know, just to show the long-term hope for Vietnam's industrial sector, have people thinking about the long term, especially industrial developers, as they try and source more high value added European manufacturers to their industrial parks. And one silver lining from the whole situation for Vietnam this year is, since 2018, there's already been a lot of multinational companies moving out of China and moving to Vietnam. The COVID-19 pandemic has actually served to accelerate that relocation away from China. So a lot of these companies, they're not just moving their manufacturing to Vietnam, but rather they're relocating or diversifying their manufacturing to Vietnam, not to keep all of their eggs in one basket. I'll talk about that more on the next slide. Yeah, so here we are. So I mentioned about the acceleration of the relocation away from China. So since the last 2 years, we've been seeing a lot of these multinational companies, especially in electronic components or even automotive, not necessarily shutting down their facilities in China, but rather just diversifying and a second or a third facility to Vietnam, just in case the tariffs continue to rise over the years. So there've been some big names so far this year doing it, and I believe with the COVID-19 this year, we've seen some new names such as Lenovo and Nintendo, and these companies from Japan also state that they want to move to Vietnam next year. On the bottom, you see Apple and Foxconn there. So some of the Apple suppliers have already shifted production to Vietnam. So it's already happening, and we do think that next year, once the travel restrictions are lifted, we do expect to see a lot more of these investments come to Vietnam. So this is what the developers in Vietnam are quite looking forward to this year, as a lot of the deals done this year are just from companies already in Vietnam looking to expand or relocate their production. There's been no market entry, obviously, with the pandemic, so they're waiting till next year so they can welcome the new market entrants into their industrial parks. And one more interesting point is as well, we've already seen how high the wages in China are compared to Vietnam, which has always been a key driver for the country. But after something like a pandemic occurs, wage inflation will usually be the first thing to increase. So this is also going to prompt more manufacturers to leave China and look at some other Southeast Asian alternatives with more competitive costs. Next slide, please. So just to move on and have a quick look at the logistics landscape in Vietnam. So I would imagine it's similar to Thailand and the Philippines in that 3PL or third-party logistics, retail e-commerce and manufacturing are the main drivers of the warehouse market. Although I heard Michael mention that e-commerce is not growing as fast as it should be in the Philippines. In Vietnam, e-commerce is certainly growing quite fast. There's a lot of people and buying everything with their phones. There's a rising middle class with higher income levels, and everyone's using their phones to purchase things now. So this is actually driving up demand for warehouse near central business districts for last mile delivery. However, there's very little supply at the moment, so it's driving up the rental prices, which is something that is a bit of a challenge now for these companies like Lazada, Alibaba, Shopee, and Tiki, is trying to get secure land that's actually close to their markets. The logistics and warehouse market overall is estimated to be worth about $86 billion by end of 2022. There's about 1,300 to 1,500 enterprises providing logistics services in Vietnam. Interestingly, a big proportion of the logistics market here is foreign investment, actually about 70 to 80%. And this is due to a lot of recent merger and acquisition deals, which has left some of the domestic firms struggling. I've put down some examples of these big M&As on the right there. So Symphony International Holdings from Singapore with their 28% investment in ITL Corporation, worth $42 billion. We see CJ Logistics from Korea with their investment in Gemadep, and also Sumitomo Corporation from Japan, also investing in Gemadep Corporation. So it's always a good idea for the foreign guys to look at good local partners in the logistics field, because the local logistics players have the land bank, they have the locations, and the foreign guys can bring, like the DHL or the DKSH, they can bring their 3PL management models, their higher value added services like inventory tracking, packaging, labeling, and merge those two together, and then they can successfully enter and compete in Vietnam's logistics sector. Next slide, please. Okay, so with regards to performance, just a quick note on the World Bank's 2018 survey. So this is interesting because in 2016, from the same World Bank study, Vietnam was 64th out of 160 countries in terms of logistics performance. In just 2 years, in 2018, we've seen it jump to 39th place. So that's quite a big improvement in a small period of time. And we see in the study overall, Vietnam, along with Indonesia and India, stood out as some top performers, especially amongst emerging economies. So we're quite confident in the direction Vietnam is going. However, there are some issues with regards to logistics here. Logistics costs in Vietnam are still one of the highest in the Asian region. And there's certainly a lot of improvements to be made with regards to the cumbersome administrative procedures involved in the port and the customs authorities, which needs to be made more efficient. And the government is actively working on that to make it more quicker and certainly cheaper. So let's see where we are in the next 5 years. It'll be interesting to see that same study and see exactly where Vietnam lands out of 160 countries. So that's my last slide. So that wraps it up here from the Vietnam office. I hope you found some of my information useful. If you have any questions at the end, feel free to ask. Thank you.
Great stuff. Thanks, John. Srinivas, over to you for India.
Thank you, Adam. Greetings to all participants and attendees. Thank you very much for joining, taking your time. Just to give you, before we go into some of the slides, as Adam had told in the beginning, what we are trying to cover, how India is poised to take on this industrial revolution for what we call, what is that India is doing in terms of the drivers and how we are attracting investments, how we are positioned to become one of the global supply chain hubs for the from India. Also, the current situation is what we would cover in next few slides. So what we have put together is India has been very promising in terms of coming out with reforms. Some of the new reforms or the recent reforms to attract investments, what they've done is they've reduced the corporate tax for the new manufacturing companies which are coming into India and setting up to be one of the lowest in Southeast Asia, which is today at 15%. Apart from this, they have invited FDI investments to come into real estate, manufacturing sector, logistics sectors. The opportunities are put forth for FDI compliant developers, capital, manufacturing clients to come into India. Some of the biggest drivers have been the logistic piece, which is the warehousing industry. Second, now with the India-China tensions, manufacturing is something looking very promising. The policies which they have come out recently are for, one is for the electronic policies, which is incentive driven for electronic manufacturing related to mobile handsets, hardwares, FMCG related electronic goods. Second is the work in progress, which it's in draft national logistic policy. And third would be with respect to the coastline and infrastructure related policy, which caters to the coastline ports, privatizing these, and the railways. So next slide, please. So as you would see, the infrastructure boost that government is earmarked or envisaged, India is one of the largest coastline between the west to south, south to east, and it's also got the largest road network infrastructure. So India has done works related to connecting all the major ports by the road networks from the entire country. They've issued to privatize these ports under the public-private partnership. Airports are already privatized under this PPP model. The latest one is government is in discussion and issued tender bids to privatize the rail networks for logistic transportation network operations. With this, the government is making efforts to boost the infrastructure to improvise the connectivity between road, ports, airports, not just within the country, and also for the global hubs, which would be between the Middle East, Asia Pacific, and to far western countries. So these are some of the recent initiatives they have taken. Next slide, please. Some of the indicators how the country has spanned in terms of catering to various manufacturing and warehousing sector. As you would see on the right, these are the key cities or locations predominantly where the hubs are in the country. These are logistic hubs, manufacturing hubs with various sectors. So up north to down south, with west to south and south to uh, east is what predominantly you would see major hubs due to the coastline, due to the consumption, due to the sourcing hubs these are. So what we have seen in the last 2 years to the current year, the trend has been slightly downward in terms of new supply stock due to COVID related reasons, but that has helped to absorb majority of stock which was vacant. So if you would see, we expect the vacancy would come down from 10% to 3%, and the absorption is reduced due to non-availability of fresh stock. But the forecast for next year is that we would increase the stock by close to 45 to 50 million square feet of fresh stock, which would get absorbed. So this would increase the total absorption, and also it would also increase the stock levels by 22%. The overall across country, the rental values have been between $2 to maximum of $5 per square meter per month. This varies from each up to each region. Again, varies between the logistics to manufacturing clients. Next slide, please. So this is just to give you a further breakdown in terms of the stock analysis, absorption, and supply coming in comparison to the last 3 years. Currently, as you would see, we are at 220 million square feet of grade A stock. This is expected to grow to close to by an addition of 50 million square feet next year. That's forecast. And the absorption would also increase. We expect close to 50 million square feet plus to be absorbed next year. Predominantly, the major sectors which are absorbing or which are taking up this space are between, on the logistic front, it is e-commerce clients followed by third-party logistic clients. Then we have on the manufacturing sector, clients from energy, electronics, FMCG into electronic goods, automobile, auto-related clients, engineering clients, chemicals, oil and gas, and lastly, it would be more from the footwear industry. These are the some of the sectors which are predominantly increasing their growth or coming into the country. Next slide, please. So how is India poised to take up this much of demand from various sectors and looking at catering to this 50 plus million square feet of requirements year on year, what we forecast? Today, India has earmarked, put across close to 54,000 hectares of land across the country, which is under various sectors. It's pure industrial lands, it's pure logistic parks, it is FTWZs, it's manufacturing EOU compliant facilities, which is spread across the country along with the coastlines, ports authority, along with the multimodal logistic hubs with connectivity of inland container rail sidings. All this is done with the help of both the government, public sector undertaking, and also the private bodies. Government has come out with list of developers in each state who would be readily providing plug and play or ready to occupy and operate for manufacturing client needs. That's one of the biggest advantage for most of the clients who are looking at coming into the country, setting up and starting their production without much of time lapse. So these are some of the initiatives that the government and private sectors in India have done. So we look forward that there's huge growth potential opportunity, and it's only what we see is to meet the global demands in terms of inviting clients, in terms of expanding their growth needs is what we have put together. Any questions we are happy to take in the last. Thank you for your time. Over to Kevin, please.
Go ahead, Kevin. Thanks, Srinivas.
Okay, thank you, Adam. Hello, everyone. Thank you for taking time to join this webinar. As you may be aware, Indonesia is the largest country in Southeast Asia. It spans nearly 2 million square kilometers over more than 17,000 islands and has a GDP of over $1 trillion US. Next slide, please. As a newly industrialized country, the industrial property market is relatively stable in Indonesia, and it's been the least affected property sector as a result of the COVID-19 pandemic. So this slide provides a high-level overview. The industrial estate activity is spread over 5 main areas. The Greater Jakarta and West Java area, that's point 1. Central and Eastern Java, that would be point 2. The island of Sulawesi, that's 3. East Kalimantan, 4. And North Sumatra. Industrial property in Indonesia falls into 2 main categories: ready-built and build-to-suit. The vast majority is build-to-suit. However, it should be noted that in the logistics sector, the split of occupancy between ready-built and build-to-suit is closer to 50-50. Assessing the market by land availability, build-to-suit facilities equate to approximately 40% occupancy. However, in the Greater Jakarta area, this is closer to 70% and is increasing steadily. Ready-built property in Jakarta has a much higher occupancy, with good logistics buildings being close to around 90% occupied. Here we also see on the slide industrial gross rents ranging between $2 per square meter per month to around $5 per square meter per month. And that's depending obviously on the location and quality of the building. Land costs range between $60 per meter and $300 per meter. Next slide, please. So with a population of close to 35 million, the Greater Jakarta area is the preferred destination for the majority, about 60% of Indonesia's industrial estates. Around 30% of this is in the west of the city and 70% to the east, with smaller areas in the north at the port and in the south. Most estates retain significant land banks, and generally speaking, there is significant availability to the east as opposed to the west. There is also future industrial zones slated for development in the northeast, which is the gray highlighted area you can see on this map. Although the main occupiers are automotive, chemical, and food production, we're also seeing notable increases in demand from the logistics and warehouse requirements. Next slide, please. So with stable GDP of between 4 to 6% over the last decade, Indonesia's middle class has expanded significantly. One of the results of this is been a huge majority of the population now regularly using the internet. E-commerce has increased proportionally to that, and e-commerce sales now are greater than any other Southeast Asian nation. As a result, we're seeing demand for logistics and warehouse facilities likely to grow in the short, medium, and long term. And this was reinforced, obviously, by the COVID-19 pandemic. And we see it being supported by the Internet of Things as it's being proliferated. Next slide, please. So despite its economic growth, Indonesia's labor force remains one of the most competitive in the region. Unskilled labor can be as cheap as just below $6 per day, and as high as around $13 today, per day. I think this has been one of the key draws for foreign manufacturers, and I think probably the lowest wages apart from Vietnam in the area. Next slide, please. So why consider Indonesia? Fundamentals. Population. It's got the 4th largest population in the world, of which over 40% is under the age of 25, as well as having a rapidly expanding middle class. Its credit rating. The country is now investment grade, and it has achieved a credit rating of BBB for the last 3 or 4 years. Infrastructure. Transport infrastructure is increasing significantly with a number of new airports, toll roads, rail connections being built across the archipelago, but predominantly within Java. And the Greater Jakarta area has built and is expanding LRT and MRT lines, which are connecting a lot of the suburbs and the industrial areas that we saw on, well, 2 slides earlier. Incentives for foreign manufacturers. The government is keen to get on the bandwagon of trying to attract manufacturers from China. And as a result, they have provided a scheme whereby they assist company setup and licensing, and are prepared to provide land subsidies. They've also prepared around 4,000 hectares of land in central Java to support industry. And that central Java area is where wages are lowest in the country. And then finally, new legislation. The government recognizes that Indonesia is still very bureaucratic and not competitive enough. So they have been pushing through the so-called omnibus law in an attempt to make this a little bit more streamlined. The key takeaways from this initial phase of the omnibus law have been an improvement in the process of business licensing. It's been made more simple to open and set up a business. Labor law. Labor law will be made more market-friendly and flexible. And a major part of that has been by removing sectoral minimum wages and lowering maximum severance pay. Foreign capital investment and 100% foreign company ownership will be allowed for more areas of business activities than previously, which is designed to also to attract further foreign investment. And taxation, which is currently at 22% for corporate tax, will be reduced by 2022 to around 20%. Whether all of those points actually get put into practice has yet to be seen, but overall, it's seen as a very strong step in the right direction. Thank you, Adam.
Kevin, excellent. Thank you for that. And I'll hand over to Kevin for Malaysia. Thanks, Kevin.
Hi, thank you, Adam. This is Kevin from Malaysia. Been with the company for the past 17 years. And thank you, Adam, bring us together. And for those that who attend the webinar tonight, I hope you enjoy with all those numbers that presented by so many countries. But I think for Malaysia, I would say Malaysia is a federation of 13 states and 3 federal territories. Population is about 32.7 million this year. We are now in the midst of doing a big e-census at the moment, with an average age of 28 years old. Next slide, please. Okay, from the slides, you can see Malaysia GDP growth for the past 3 years from 2017 to 19, average at about 5% growth. The current top 2 main drivers of industrial demand in Malaysia are services and manufacturing. In terms of subsector under services will be retail, F&B, ICT, private, healthcare, professional services, and tourism. We are aware that tourism are actually badly hit this year, and we are actually relying on manufacturing subsectors, which is E&E, semiconductors, machinery and equipment, chemical products, and pharmaceuticals. The services sector grew at the fastest rate. You can see in 2018 at 6.1%, up to 6.8% in 2019. This growth was mainly driven by consumer-related spending, particularly in the food and beverage and accommodation subsector, as well as motor vehicles. And the finance and insurance subsector also registered higher growth last year, mainly due to the higher fee-based income. And the continued demand for data communication services contributed to grow in the information and communication subsector as well. While the sustained growth in the transport and storage subsector was largely supported by air freight and port-related activities. Transport and storage retained an average share to Malaysia GDP at 3.7% for the past 3 years, and also registered the strongest growth at 6.8% last year. So that is about services. And the next one will be the manufacturing that we are focusing tonight, where you can see the manufacturing sector grow in tandem with the economic expansion. Retained a substantial share to Malaysia GDP at 22.5% last year. You can see this is a significant growth from 3.8% in 2018 to 5% in 2019. So our federal government is actively involved in the continued promotion of export-related activities, with an emphasis on productivity and innovation across all the manufacturing sector. The focus will be on the value-added manufacturing activities and the downstream production of products from palm oil, rubber, petroleum, and gas. Our central bank forecast GDP may shrink to negative 5.5 this year due to the pandemic. But with all the containment measures, our finance minister thinks that a rebound of up to 8% growth next year. So let's see how it's going to pan out next year. Next slide, please. From these slides, you can see these are the 5 major key economic corridors, related to logistics and manufacturing activities. So the investment opportunities are all listed, in all these 5 key economic areas. Of course, from the north, which is the NCER, which covered 4 states from Penang, Kedah, Perak, and Perlis. The main industrial sectors in this location will be E&E industries and semiconductors. High-tech, high-value based products, solar wafer cells and modules. These are the names that you will hear from Invest Penang every year when they have seminars to invite all the foreign investors to Penang. In February this year, I'm not sure how many of you are aware that there's a California-based Fortune 500 semiconductor companies, Lam Research Corp. They have announced that they will set up a production facility at Batu Kawan Industrial Park. These new facilities will cover about 700,000 square feet and will be expanded in the near future. Okay. In terms of other key economic corridors towards south, which is Iskandar, Malaysia, I will say that the land price in this area is between USD 80 per square meter to 260 per square meter. So they are focusing on E&E as well, petroleum products, rubber products, petrochemical industry, automotive warehouses, steel-based industry, food and agro processing. Hershey have set up their plants in this region. BMW and Volkswagen have also built their new regional parks and distribution centers here. As for ECER, this is the East Coast economic corridors. They are focusing mainly on the heavy industry, resource-based, and the labor-intensive. If we move to the east, which is Sabah and Sarawak, the similar sectors you can see, which is a resource-based and also the utility-intensive sectors are well covered in the 2 states in the east of Malaysia. Next slide, please. For these slides, we will talk about the international airports and the seaports. I'm not sure how many of you are aware that there's a total of 6 international and 19 domestic airports in Malaysia. So we are having a great connectivity from air, sea, highways, provide accessibility to all these airports and seaports. So Malaysia is strategically located at the center of regional logistic networks. So industrial parks normally built less than 50 kilometers from either airports or seaports. For those foreign investors who invest on the freehold land or even leasehold land for the past 20 years, I believe they are now enjoying a higher growth and higher demand on the, I would say, selling price. And another point that I would like to highlight, the condition of the land in Malaysia generally are solid ground. For land located between, I would say, 10 to 50 kilometer radius from the sea, normally it will require a minimal piling works due to solid ground, as compared to those lands that located less than 10 kilometer radius from the sea. And some of the industrial lands used to be an oil palm plantation, hence less contamination risks, and also lower construction piling costs as compared to those lands that located near to the seaports. Next slide, please. From these slides, you can see this is a Greater KL. This is the most established industrial clusters in Malaysia. I would say that in terms of population, about 8 million population are staying in this region, which is about 24% from a total of 32.7 million population mentioned earlier. And these regions are supported by 11 highways and 3 seaports under Port Klang, which is North Port, West Port, and South Port. DHL has a footprint of more than 1 million square feet warehouse in this area, which is Shah Alam. And IKEA having the biggest regional DC in Asia Pacific in Pulau Indah, which is in Klang area. If you can see from the map, Klang, so the Port Klang is located within that area. And Nestle also built their new warehouse in the Klang area. So in terms of industrial land price, it's ranging from US dollar 160 per square meter to 500 per square meter. In terms of rentals, I would say it's between US dollar 390 to 650 US dollar. So industrial parks in Klang Valley, for example, like Bukit Raja Industrial Gateway, you can see that some Japanese players like Mitsui & Co, they have joint ventures with the local largest landowner, which is Samdabi. And another highlight will be a digital free trade zone, where you can see the local Post Malaysia joint venture with Lazada, and also Alibaba through China have built 1 million square feet fulfillment center in this digital free trade zone, DFTZ. In terms of aviation industry, Parker Aerospace, Eurocopter, GE, AAR, Honeywell, these are the companies who are surrounded around Subang Airport. If you look at the map towards the east, which is Kajang, Semenyih, Belakong, this area are mainly local manufacturers. Next slide, please. Key questions. I've been hearing people asking, globalization's ending, or we are about to witness it reaching the next renaissance? I think from Savills Malaysia, we believe that it is far from over. The fourth industrial revolution, which is Industry 4.0, is a fundamental change in the way products being produced, delivered, and consumed. We need 5G, probably 6G in the near future, and the infrastructure and the ICT connectivity in Malaysia all built around it. Industries are going humanless, remote conferencing like us, but what we are doing right now, less traveling, global village talents, and etc. I think factories in the near future, most of them will be automated robotic. We have no robotic, we have no robot tax yet, unlike some of the EU countries. So I foresee that the robot will override labor costs to a certain extent. With robot needs educated workforce at a reasonable cost. That we have many to offer. A fresh grad in Malaysia, their salary is still less than US dollar 700 or about 3,000 ringgit per month. Still relatively cheaper. Of course, it's not as cheap as other countries. With globalization plus 5G plus automation with smart technologies, I would say that, for example, talents in Taiwan or US with the infra in Malaysia can get the things done easily. The next point will be e-commerce. I think with the recent COVID-19 pandemic, I believe changing every aspect of our life, how we work, how we shop, how we leisure in the new normal. And most of the SMEs or enterprise have to relook into their business model and to transform and innovate their businesses for survival. I've seen many of them manage to keep afloat by going digital. Yep. For next point, which is leveraging on infrastructure and fulfillment capabilities and of e-commerce system. Some of the mono brands from fashion, sports, household goods, cosmetics, healthcare, foods, auto parts, they are all selling very well in the e-marketplace. Shopee, Lazada, we heard Lazada have recorded the 4 times jump, on the 10-10 one-day sales. So activities within the e-fulfillment hubs, for example, like cargo terminal, fulfillment center, sorting center, and warehouse. All these are coming and changing the landscape of the warehouse in Malaysia. Next point will be adoption of new technologies. In August this year, our current prime ministers have not changed yet as of now, have announced that he's going to come up with more initiatives with the aims to upgrade Malaysia digital communication infrastructure. But some of the other areas of concern that need addressing are competent manpower to lead and manage all these digital platforms, infrastructures that can implement the processes, ways, means to ensure that the security of all the digital information. I think in terms of cybersecurity, I believe so far there's no concrete evidence from any companies or communities that produce evidence that 5G carries cybersecurity risks. Next point will be logistic companies to diversify revenue streams. Today, everybody is slowly learning the advantage of doing all kinds of transactions from home. Consumers are, growing to buy things online. Back then, we will be buying fruits, fish, meat, and vegetables online. But now, most of us do so fairly happily, which is a rather dramatic change in our mindset. This goes to show that cold chain logistics and food retail logistics is now a permanent and exciting part of our future. Next point will be strong governance. Malaysia, we have a good law based on torrent systems, tax audit compliance law. Our laws are less sophisticated. Under a torrent system, the registration of any titles is everything, and the state will guarantee an indefeasible title to anyone that who register on the title. So foreign investors could own freehold land or leasehold or even lease in certain ports in Malaysia. So Malaysia, as you are aware, is the neutral country. So we remain business friendly to all. The legacy inherited from British Commonwealth education system, our industrialization experience by American manufacturing revolution. So Malaysia, we have a lot of that talent from the past 40 years of industrialization, who could serve English, Malay, Tamil, and Mandarin speaking customers for US companies. And the final points will be the strengths in the semiconductors and EV sector. I would say that the traditional business model is low-cost human capital to generate profit. And the current business models, if you can see, certain developed countries is looking at low-cost capital, extended to non-human realm, or with human-robot collaborations to generate profit. That will require a pool of highly specialized workers, which Malaysia could offer. Welcome to invest in Malaysia. That's about it from my side. Thanks.
Thank you, Kevin. As usual, very thorough. Thank you. Sharon, over to you for Singapore, please, to take us home.
Finally, hi everyone. So after hearing my colleagues covering India and Southeast Asia, I'll kickstart with really what makes companies want to consider Singapore in relativity to my subsequent discussion points. Next slide. First, top tech companies like Twitter, Tencent, Zoom, Snap, what do they really have in common? They've since expanded into Singapore in the middle of a global pandemic. So Singapore has been attracting world-class talents in the world, as the city-state houses 80 of the world's top 100 top companies. Second, Singapore's best-in-class digital infrastructure, been first in Asia, has also rolled out 5G networks this year, with 5G covered expected to cover at least half of Singapore by end of year 2022. So really, together with a world-class transport system, steady water supply, reliable power supply, the Singapore government is ensuring your business stays competitive and definitely customer focused. Third, Singapore has a business-friendly environment with a transparent and streamlined business regulations and processes. We've got a fully digitized processes, and 15 minutes is all it takes to register a company online, quickest in Southeast Asia apparently. Fourth, Singapore remains one of the world's strongest economies with political stability, low corruption rates, transparent public institutions, sound monetary and fiscal policies, and strong legal systems. And according to Euro Money Country Risk 2019 survey, Singapore is one of the least risky countries for investment. Last but not least, Singapore is one of the world's most connected countries, strategically located along the world's major trade, shipping, and aviation routes. Well, with most of you might have already been familiar with Singapore Changi Airport, regularly ranked as the world's best airport, serves more than 100 airlines flying to about 100 countries and territories globally. So next in the slide is actually the map of Singapore, which spans just about 720 square kilometer land with a population estimate of 5.7 million. Industry and commerce land use in Singapore stands at just about 14% of the total land supply. Average industrial occupancy rate is currently at 89.4%. Our ready-built warehouse and factory gross rental rate ranges from 10 to 28 USD per square meter per month. And these are on leasehold land, as the Singapore government owns 90% of the land. As you can see from this map, we've highlighted the major industries clusters currently operating within the area. We've largely grouped them into three key areas. Decentralized areas has a high concentration of heavy and pollutive manufacturing, especially in outlying areas. Presence of more industry-specific clusters, which are usually centered on large-scale industrialists, example, the MacTech Hub and the Jurong Island. Second, the fringe central business district, which is a natural synergy and spillover from the CBD, catering to occupiers who are cost-conscious, prefer more collaborative spaces, towards a clean and light industrial activities, but still requiring considerable office-like spaces. So the fringe CBD has the highest proportion of high-specs industrial and business parks, and a tendency to be located nearer to residential and other amenities. Lastly, the CBD. It has very limited traditional industrial activities, natural concentration of finance and insurance with supporting business and professional services, and a rising proportion of infocom and technology activities, which are defined by Industry 4.0 trend, digital connectivity. So what's been happening around the industrial segment in Singapore? In the next slide, Singapore's largest industrial landlord, JTC, has played a pivotal role in keeping Singapore's industrial landscape innovative and forward-thinking. They are constantly breaking ground for the next generation of industrialists with master plan development such as the Jurong Innovation District, JID, a 600-hectare new hub for advanced manufacturing. Just as yesterday, Hyundai had a virtual groundbreaking ceremony to build a USD 300 million innovation center for future mobility studies at JID, which will develop new automotive technologies, including for the production of electronic cars. And we've got real estate investment trust like Ascender REIT, which is part of the Capital Land Group, is also rejuvenating their portfolio with asset enhancement initiatives to fully utilize the land intensifications. The next slide will show more of the ongoing portfolio rejuvenation. So if we were to move on to the next slide. Okay, so this shows the major industrial developments with the recent development of assets from light industrial into high-spec development and maximizing the plot ratio with new facilities. Okay, next. Well, even as late as the third quarter of last year, there were fears of saturation in the data center market in Singapore. However, with 5G, working from home, wider use of video conferencing and e-commerce driving up demand for bandwidth and data storage changed all this. So prior to the entry of these demand drivers, data center was already popular amongst investors. They were drawn here mainly because of the several key reasons, which I'll put it as the Singapore's ability to maintain a continuous power supply, no natural disaster risk, global connectivity, skilled workforce. And we've got notable occupiers with their data center in Singapore. Zoom, which we're all logged onto now, has opened its first data center in Southeast Asia in Singapore. Facebook, building their first Asian data center in Singapore as we speak, investing US 1.03 billion. Google, building not first, not second, but their third data center in Singapore to meet the rapid user growth in the region, bringing its total long-term investment here to US $850 million. Amazon Web Services having 3 availability zones in Singapore. Alibaba Cloud having its IHQ and second overseas data center in Singapore. And of course, the list goes on. So next, in demand trend we're seeing is actually the logistics in the next slide. And really, with or without COVID-19, e-commerce is expected to be the fastest growing segment of Singapore's digital sector over the coming years. Revenue this year from the e-commerce market is expected to exceed US 2.7 billion. This trend is expected to be accelerated after COVID-19 led more businesses to jump onto the e-commerce bandwagon, well, basically to remain within the retail ecosystem, and social distancing measures as well as the lockdowns continue to force businesses to innovate. In the next slide, well, we can see the current COVID-19 situation has brought the issue of food security into sharper focus in Singapore. Singapore does not have natural resources, and agricultural land use is just about 1% of the land area. We've got a 30 by 30 goal, which is to produce 30% of Singapore's food supply locally by year 2030. Up from the less than 10% today, to strengthen the resilience of Singapore's food supply. So really, how's the Singapore's industrial outlook this year? So to summarize in my last slide, as the pandemic and prolonged disruptions left many businesses badly affected, more companies are embarking on cost containment and restructuring measures. As such, occupiers, especially those in non-e-commerce industries and with large spaces, may consider downsizing as they consolidate their business while reducing their workforce. And even though there are expected delays in some projects' completion, thereby helping to ease the potential supply glut in the near term, we reckon that the occupancy and rental levels are still likely to be under more pressure, particularly for the factory segment. And of course, some segments will have a better potential to recover later this year. With the stockpiling ongoing, the warehouse segment may find some support from spike in the logistics and storage needs. Business park and high-spec industrial segments may see a gradual pickup as business sentiments improved. So we reckon the average the rental lease rate will probably be a variations of contractions of about 5%. That's for the remaining of this year. And with this, I thank you for your time and shall hand over to Adam to continue with the Q&A discussion.
Thanks, Sharon. Fantastic way to finish your presentations. That's terrific. Look, everyone, just conscious of time remaining, I might just zero in on a couple of questions. And Sharon, the first one might be back to yourself. A question here just regarding Johor Bahru, or the south of Malaysia, and how is that being kind of integrated into the strategic planning of Singapore manufacturers?
Sorry, Adam, I lost you for a second.
So the question was just around believe that the role of Johor Bahru, the south of Malaysia, and how that's being integrated into the strategic planning of manufacturers in Singapore. How does that feature as part of their planning and strategy? Has it had a significant impact on the way that they operate in Singapore?
Yeah, well, actually, as you can see, Malaysia has always been a great neighboring country, a partner, strategic partner for sure. And with the land bank that we have, specifically and we've got no natural resources. So especially so in terms of our populations, with just about 5.7 million to date. So it's very much dependent across the causeway to welcome the foreign talents that we have. Partnering with the foreign talents in Malaysia coming over here. As for this is how the ongoing collaborations as well as the strategic agreement that we've been having with the Malaysia government all along.
Fantastic, thanks, Sharon. I've got a question here for Michael from the Philippines. There's some discussion earlier about some of the challenges that manufacturers or logistics operators face in Vietnam in terms of navigating that market. The question is, what are seen as some of the key hurdles, challenges to establishing, expanding manufacturing or logistics in a market like the Philippines?
So probably the the hurdles stopping some manufacturing in the Philippines is our cost of electricity. It's one of the higher rates in the region, potentially twice that of, say, Vietnam's, and potentially twice that of, say, Thailand's. So
Okay.
anything that's heavy electrical consumption could be a challenge. Overall, the regulatory environment, we're definitely not setting up a business in 1 hour or 1 day or 1 week. Possibly we're looking at about a month to incorporate something. We do have a one-stop shop, which is run through PEZA, which would help you with your visas. But Philippine time is kind of on average about a month for all of this stuff to happen. Now you can do a lot of work and you can be kind of semi-operational, I guess. You can start hiring people, or you could, probably start some pre-operations while you're waiting for all of these permits to come in.
Okay, great. Thanks, Michael. Look, as I say, everyone, just conscious of time, we might end it there. The back of this presentation, which we'll certainly distribute to everyone, we do have everyone's contact details. Please feel free to reach out to myself or the other panelists if you have any specific questions you would like addressed. For any others that are panel queries, we'll look to come back to people separately. But I suppose just finishing up, look, on behalf of everyone attending, I'd just like to really thank the panel for their participation. And thank you, obviously, to everyone's attendance. Do hope that you found the presentation of value. And certainly everyone, wish you all the best for what's remaining of your day, wherever you might be in the world. Thank you very much. Cheers.
Thanks, Adam.
Yeah, thanks, Adam. Thanks, all.
Thanks, Adam.
Thanks, Adam, and thank you everybody for the time today. Cheers, and see you guys.
Thank you all. Bye.
Yeah, thank you. Bye. Good night.
Thanks, Adam.
Thank you, Adam. Thank you, Stella and Ruby. Thank you. Night.